Whether it's learning about earnings estimates, exploring the Zacks rank, or adding to your financial toolkit, get the education and resources to help you become a more successful investor here on Investing the Zacks Way. Well, given that third quarter earnings announcements are beginning to roll in now, Steve has agreed to share 3 strategies with us to profit from during this earnings season. So we welcome back once again our editor-at-large, Steve Reitmeister. Welcome back.
Thank you.
So then, why is this such a special time of year for the stock market?
There's few things that move a stock faster in either direction, whether up or down, than an earnings announcement. We've all had that experience as an investor, waking up in the morning and seeing that one of our companies had an earnings surprise and it jumping 5, 10, 15% on that news. Unfortunately, we've also had that dreary morning where we wake up and we see that one of our companies has had a negative surprise. And unfortunately, they fall fast and they go up, and that stock could be down 10, 20, 30% very easily on a bad announcement. And especially now in this bad economic environment, bad news, those stocks will really be beaten up these days. So we want to talk about strategies that hopefully line your portfolio with more stocks likely to have positive surprises and avoid those dreary mornings. And we're also going to talk about some strategies that work very well after the earnings surprise that a person could do to increase their likelihood of profits in the days ahead.
All right, so let's get right to it. Strategy number 1.
Yeah, strategy number 1 is we talk about 4 leading factors that are likely to point towards a positive earnings surprise. And yes, we are talking about the 4 factors of the Zacks rank, but before you tune us out, I've heard that story before, Steve. I want to kind of give you a little bit of the backdrop of how these factors were created and why it's so important during earnings season.
Okay.
So Len Zacks, a mathematician, he took his skills to Wall Street in the mid-'70s, and his job was to create strategies that help pick better stocks. He came up with a theory that if you could find leading indicators of what stocks were likely to have positive surprises and therefore what stocks were going to have negative surprises, if you could know that kind of ahead of time, that would be a big, big advantage in an investor's hands. So he spent years taking a look at things that might point towards stocks more likely to have an earnings surprise. He came up with the 4 factors. We're going to roll through them real quick here because we have tons of videos on it, but the 4 factors that most of you already probably know, agreement, magnitude, upside, and surprise. I'm not even going to go over them beyond that, but these 4 factors individually each point towards stocks that are more likely to have positive surprises. Okay? But when you put them together, when you're blending them together in the Zacks rank, the advantage towards the investor is almost obscene in having a portfolio that is lined up with good stocks. And here again, knowing which ones to avoid and that will be going down on the news. So the 4 factors of Zacks rank, you absolutely want them in your favor going into earnings season.
Okay, good. Then the second strategy for profiting during the earnings season.
One of the ways in which to increase portfolio profits is to minimize losses. And this is probably one of the simplest strategies that people can employ, and yet they find it the hardest because we're talking about that if you have a company that has a negative surprise, it's going to fall in that news, and what we're trying to tell people is sell it immediately. Here, I'm going to look right in the camera. Sell it immediately. What happens is, it's hard for people to take losses. We talk about ego and fear and things that get in people's way, stopping them from doing. But also one of the things that stops them is they take a look, well, let's get some news on this. And the news they get comes from the companies themselves, as their press releases. The company's going to put the best possible spin on what is happening out there. And I'm not saying it's lies. I'm just saying it's the best possible face they can put on it, which will keep investors from fleeing from the stock. Rarely is a bad earnings quarter a one quarter phenomenon. It usually has a way of picking up steam. That's either because it's bad economic environment. The industry has deteriorated faster than analysts predicted. Okay, so that's one reason. The second is that corporate management didn't employ the right strategies or didn't predict properly where their earnings will be. Either one individually is a reason to get out of the stock. I mean, you don't want to be in a failing industry, and you don't want to have your money in the hands of corporate management that doesn't properly estimate where earnings are going to be and doesn't properly put in strategies that will grow the company. So negative surprises, we are out.
Okay. And we've talked about, selling a stock, how hard it is to sell a stock for a loss.
Yeah.
But I guess it's better to lose 10% now than 20, 30, 40% somewhere down the road.
And that's our point, yeah.
So you mentioned earlier that the third strategy would be, you mentioned it to me anyway,
okay.
before we started taping, buying high and selling higher.
Yes. And
as kind of a tip of the hand there for you, but that is the most profitable?
Yeah, this is the most profitable one, and in some ways the hardest to do because we're so ingrained in our head, buy low and sell high. And so it's very hard for us to buy a stock that just had an earnings surprise. It rises on the news immediately. We find that we can get into these stocks and ride them higher in the days ahead. So here again, that's the idea behind buy high and sell higher. Not every company that has an earnings surprise will jump on the news. Okay, there's a lot that the street was actually expecting a little bit more money, and you'll see them sell off, and that's the classic buy on rumors, sell on news kind of scenario. Mm-hmm. However, there's a unique blend of stocks, and Len Zacks put a lot of time and effort in this one, and he created another predictor like the Zacks rank, which is called the price response indicator. The price response indicator is taking a look at a rare combination of stocks where the price was falling into the earnings announcement, meaning that Wall Street thought that the earnings announcement was going to be terrible and started to move away from the stock already. But those companies where the stock price was falling into the earnings announcement and then has a big earnings surprise, I mean like a 20, 30+% earnings surprise, those stocks are going to jump like crazy. And now it's almost like Wall Street was leaning in the wrong direction. They were selling off in the stock. The stock jumps at the open, and yet still we know that we can get into those stocks in over about a 2-week period. Those stocks will continue to rise as the rest of the investment community catches on. Oh, what happened here? Oh, that stock had a great earnings price, and they jump in, and we see those stocks go higher. The price response indicator is only available to our institutional clients, but we do have a service for individual investors called the Zacks Surprise Trader, where our traders, we take in all the signals. We take a look at the 2% that have this favorable, buy high and sell higher kind of attribute, and we hand select the ones for the individual investors, and it's been our most consistently profitable service. Since we launched it in May 2006, it's up 47% as a portfolio, while the market in that 2-year plus stretch is down 6%. So it's been a phenomenal service.
It's interesting, but given the craziness this year in the stock market, do you believe that the surprise trader strategy would be effective?
Yeah, that's a great question because, a lot of strategies, they work terrific in bull markets, and then in bear markets, they fall apart. Right. And this is one that we have seen be a consistent winner in all market environments. And I think the reason is because in a bullish environment, the economy is usually going well, and a lot of companies are having great earnings. So there's no there's nothing that phenomenal about that occurring. But in this bearish environment, in a recessionary environment like we're seeing right now, having a great earnings announcement is a bit of a shocker, okay?
Sure.
And is going to stand out. So in a world where people are really, what should I invest in? Is there anyone doing well out there? And then you see this company have an amazing earnings surprise and truly surprise the street, that investors will really lock into that one and start pouring the money. So we believe it's not just effective in down markets, but incredibly effective in down markets.
Interesting. And I do have an editor's note for everyone watching that the Zacks Surprise Trader is on sale through midnight, Saturday, October the 18th.
Yes.
And if you're interested to learn more about the service and the special offer that goes along with it, then you should go directly, and I mean directly, to 3ws.zacks.com/surprise trader. Put it up on the screen for you so that you can get your pencil and paper. Zacks.com/surprise trader. With our editor at large, Steve Reitmeister, investing the Zacks way, or at least learning how, I'm Terry Ruffalo.